Dangote Sugar Refinery plans to borrow 50 billion naira in both Series 4 and 5 of its 150 billion naira commercial paper issuance. This puts the total estimated revenue from the two series at 100 billion naira. CPs have a 181-day tenor and a 20.65 discount rate percentage available through Series 4 of the company's 150 billion naira commercial paper issuance programs. Now, in contrast, the Series 5 CPs are issued at a discount rate of 21.17% and having a tenor of 265 days. Ajibola Tobi-Osho, financial market specialist, joins me now to discuss this further. Ajibola, good morning to you. It's great to have you on the Global Business Report. How are you today?
I'm very well, thank you.
Great. Very well, thank you. Now, of course, the CBN offered a total of 508 billion naira. But we saw a subscription of 1.6 trillion naira. How would you interpret that level of demand overall across its tenors?
Well, it was expected. On Tuesday, the MPC community, they met, and then the CBN announced the decision of the MPC, where they raised the MPR rate by about 150 basis points. Right about then, we have an auction. It was expected from the market that a lot of speculators would then want to check around how far the federal government and the CBN are ready to stretch out rates, whether it's going to impact rate immediately or not. So people want to be careful around where they will be bidding, because if you check the bid range, it was between 18.5 and 26%. That is evidently showing that, okay, people want to be like, okay, how higher is the interest rate going to be at this auction, given that it's the first auction immediately after the raise of the MPR rate. So it was expected, it was largely expected. A lot of speculations entered into that bid. So largely, you could say that 50% of the bids that went for that auction yesterday, they were highly speculative. They just wanted to see around how high the CBN is ready to stretch out rates.
So really
it was
expected.
There. Yeah, no surprise
okay,
at all.
All right. Now, 1.4 trillion naira in particular for the 364-day paper. Why the surge in demand for this particular paper?
Like I said, it was largely from speculations, because even before and after the MPR rate was raised, Treasury bills for the longest tenor instrument was trading around 20.5% in the secondary market. So despite all this, people were just like, okay, if they can raise the MPR rate by 150 basis points, what then is going to be the translation? What then is going to be what is going to happen to yield? We expect that to be translated to yield. Do you expect federal government, or do you expect the CBN to raise yield to be a bit reflective of the MPR rate? So, like I said, it was strictly speculative. And then fact came in again, and you had more money at hand, because before the auction, the market was very, very illiquid. We have about 1 trillion negative figure in the market. But by the time fact came in, this boosted market liquidity, and this boosted people's morale to be able to go for the auction. And then also we've been seeing a trickle of FPIs coming to and being interested in secondary market. Like I said, the longest dated paper had been trading around 20.5%. That shows that there's still interest from FPIs around to buy, and even asset managers and the PFAs are kind of rebalancing their portfolio to take advantage of this high yield. So actually, across all investors spectrum, there's still a lot of interest, especially in Treasury bills. 20.7% is still a good rate to buy at. So you'll still continue to see that interest for the while being, but particularly this large volume can be it's a mix. It's a mix of speculations and real demand. That's why you saw that they're still able to sell at 20.69%, which is just about 1 basis point lower than where they sold before. So it was expected. You expect that a lot of people will go in to go and check out where
and certainly, as you mentioned, fact also played a role there in the dynamic.
Exactly. So liquidity, the very liquid market, and also it was expected. Right. Maybe if the market was not that liquid, we would have seen something a bit lower. But with a liquid market, you have money at hand. Why not play at the market? It's just very simple.
That's a fair play on that.
Yeah.
Well, let's look at your concerns around the interest expense for the government. What do you share in this concern?
Well, I would say that is even more reflecting on how they've been increasing rates. You've seen that rate has steadied for like 4 auctions back to back. It shows that they are really looking at that, and they are really trying to send a signal. If not, why after this auction, why didn't they just raise the interest rate? Even for yesterday auction, it took a while before they released the auction result, which is unlike them. Usually, by the time auction result closed for 1, latest by 4 or 5, you get to see auction result. But auction result was released around 8 p.m. yesterday. It shows that there were a lot of of back and forth between them. You would know that there were a lot of back and forth on deciding on whether or not to raise interest rate. But I would think again, why would I raise interest rates if the market is still ready to buy at the level that I'm selling, right? Why would I incur more cost for myself? If I want to incur more cost, they need to ask for it. If the market investors are not asking for it, why do I then need to raise interest rates? So yeah, I think it is a lot of concern for them. If you look at how high they've been raising interest rate from the administration of February till date, it's a lot. I mean, and it's continued to grow as they raise more and more money. So yeah, I would expect that as around the mid-year and closing to the end of the year, they'll start, sticking for ways at which they can, minimize and drop interest rate slightly, but maybe we're not there yet. Maybe they'll still continue to level around where it is now. We don't know how far. I don't know how far they intend to, but around now, I expect that risk should still normalize around where it is.
Right, so
until we ask for more, until investors ask for more, until there's a need to raise rates, I don't think there will be any need to raise it aggressively.
All right, that's fair enough. Now, perhaps this is related to my last question, but we didn't see that much of a rise in rates from this auction, comparatively speaking, with the previous one. Yeah. Why is that?
The demand was very good. If you look at it, they were able to still raise about 500 and something trillion at 20.7%. Like I said, if investors are not asking me for more, why do I then need to? So that means if they were going to sell more, they would have to, if they are going to sell more, that would then need for them to raise rates. So if they don't have to raise rates, why do I need to raise rates? So it still goes back to answer, if I don't need to raise rates, investors are not asking me for more, why do I give them premium? I don't need to incur more cost for myself. So we can look at it as from the perspective of interest expense management, which I think it is what it is for now.
So you need to see, you mean, if there's no need for it, why
yes,
bother?
Exactly. If there's no need for it. Like I said, secondary market has been trading steadily around 20.4, 20.3, 20.5 for the past 2 weeks. So there is no need. It is evidence that there is no need. The investors, as at this moment, as at now, as at today, are comfortable at buying at 20.5, 20.6, 20.7. If they then ask for more, yes, they might need to increase it. But for now, that is where the market is trading, and I think Treasury Bill's auction would peak from that.
But with the latest rate hike at the last MPC meeting that we saw this week, won't investors be demanding higher rates in subsequent auctions?
Okay, so let me take you back to March. They raised the interest rate by 200 basis points. But if you check the auction result then too, nothing happened. It was still steadied, right? It was steadied for a long time. So that was part of what we were trying to gauge in the market when I said a lot of people went in speculation. Like I said, if you look at from the last auction, a lot of people steadied. It just shows that for some reason, the market is comfortable around this. If I don't have to sell more, if I don't have to sell more, if I don't need to sell more, then why do I need to raise the rates? So I don't think it's largely tied to the MPR as at now. When MPR will be a bit reflective at the real sector, they will have to pay the grunt for it. But for now, for Treasury bills and for bonds, I think for now, all they are focused on is ensuring that what they need to serve, they serve it right. What they need to give, they give it right. At the moment, economy is still striving at 20.5, it's still striving at 20.7. Yes, MPR rate needs to be a bit reflective, but when we need to get that, we will get there.
All right. So are we seeing the same investor appetite for sovereign bonds issued by Nigeria?
Yes, there was, because from the last auction, the volume on offer was about 450 billion, and then the federal government was able to raise about 680 billion, which is a very, very good size. I mean, the new 2033 paper, the coupon was around 19.89, and I think they had to stretch it that far because they needed to raise the size they want to. So yeah, market is fine. I would say that maybe we're getting a bit tired. The supply is getting more and more, but you still have some key players in the market that always need to buy. We have the buy side that will always be in the market to buy, the likes of the PFAs that are not allowed to invest outside the economy. So those would always be a permanent buyer for all time, and they will always continue to support the auctions from time to time. We have the asset managers too that, they are taking advantage of the high yield environment. And you have the FPIs too that are coming in. So all these kind of investors will continue to support the market, and we'll expect that within this period should normalize around this. It still goes back to my first saying, where there is need to increase rate, they would. But if they don't need to, why do I then push my interest expense? I'll continue to over around this until there's a need for me to push it higher.
So the outlook on investor sentiment is still quite healthy. In that case, we can always get better.
Yeah, it can, but it is very LD. It's still positive outlook for the country. I mean, at the minimum, we're managing our FX situation very well. We're trying to be very, very strategic about it, and then from time to time we get to see a bit of inflows coming from time to time. And yes, if the last increase that happened, the major increase that happened that made the CBN governor float OMO at 21.5%, there was an investors call, there was an FPI call, and they asked for it. So I would expect that until there's a need to do that, then we will stay around.
No need to rock the boat.
Yeah, it's not need to rock the boat. It's not need to rock the boat.
Fair enough. All right, let's talk commercial papers and Dangote Sugar now. Firstly, for our viewers where this could still be a little bit blurry, for what are commercial papers?
So we can just think of commercial papers as treasury bills issued by large corporates and large banks. So commercial paper, I mean, the textbook definition is like an unsecured promissory note, but just for layman, just for quick understanding, just imagine treasury bills issued, but not by the federal government, but by large corporates. That's what it is.
Okay, that's pretty straightforward. Yeah. That's pretty. Well, let's look at the rates now. 20.65% for Series 4 and 21.17% for Series 5. How are we interpreting this offer?
Well, that's a bit reflective of where what they call Dangote Sugar's what they call this thing is rating are. So I would expect that for corporate that need to come to the secondary market or to come to the market to raise the interest rate at which they raise these monies will be a bit reflective of where their ratings are. So Dangote was able to do this. This is high too, because compared to the 182 days treasury bills, that's around 17.5%. So this is about 300 basis point increase. So yeah, they would ask for it. They would demand for that credit spread that shows that you're a large corporate. So I would expect that corporate firms that are coming into the market would actually going to raise rates at very high rate. MPR rate would be a real burner for the real sector. They are the ones that will bear the large of the grunt for me, because for you to take my money for me to give you my money, then you need to pay something. You have to pay a premium over what treasury bills will give me. So that's what I expect. That's what I see that is happening here. And for a large Dangote Sugar to be raising money at this, so imagine a smaller company that needs to raise money. I expect that their premium will be way higher than this. So
right. Yeah, now, talking about that before, the same question on treasury bills. With the rate hike we saw this week, how is this likely to influence the commercial papers coming out of other companies?
Well, I would tell them, welcome to 2024. Welcome to 2024. Because they've enjoyed low interest rates for a while, even when they need not to be so. But yeah, that's what we are taught over time. Like this continuous rise in NPR rates will continue to hurt the large corporate, and it will get to a stage where, because I know it's not every good that you can pass through your cost to. I mean, you can, as your interest expense continue to grow, some consumer goods you're able to pass through your cost on, but some you can't. So then that means the margin line will thin out, and then for some reason, maybe with some, then I've started seeing some people have to close down. But for the time being, large corporates should just brace up for it. The time of low interest rate, single interest rate is way gone. We would expect even higher and higher for people that have very, very bad rating. Like I said, some company might have to even raise higher than as close to as 25 to 30%. So yeah, they should just brace up for impact. It's 2024, and that is what they need to just open their eyes to reality. I would even expect that most people would rather not even come to the market and just stay it out, because they don't want to. But if you need to, because Dangote Sugar, for instance, I'm sure that raising was just for working capital or some sort of short-term funding, but they needed to, and then they had to raise it. Compared to bank borrowing, which would be much more expensive. And I hear now that banks are borrowing and giving loans at 5%. So that's a lot. That's a lot of cost on interest expense. So go back. Welcome to 2024.
Yeah, it's interesting to see how we got to this point. Yes, but it's best, like you said, to just be aware and prepared.
We have to be
for
prepared.
What to expect.
Exactly.
Really.
Exactly.
I mean, that leads us to interest expense, which is, you've touched on it in many ways here. For companies issuing these commercial papers, what are the implications?
I mean, like I said, we'll have different kind of companies. Those that are able to pass through their costs to consumers, and those that are unable to. So we just technically get to see margin things out, because whether or not you're even able to pass through your cost, we expect that quantity then would then drop, because a normal consumer that would have bought 100 or 50 of an item before, then would have to reduce the size based on where the prices are now. So it's a very hard time. We expect that real sector would feel the heat. They'll feel the hurt the most. Some people might not be able to go on. I really expect that. Even now, we have to be very careful in what we invest in, because there's an high chance for default. The higher you continue to raise money, there's an high chance that you're unable to pay back. So even in investing for investors, for the people out there, they have to be very, very careful in where they put their money at. You just don't put your money in any investment because you're earning 50%, you're earning 60%. You need to think about the ability to get your money back, right? It's very, very important at that. So when you're investing as an investor, you have to think first of the kind of company you want to invest in. Let's say you're not even moving past Treasury bills, the kind of company you want to invest in. How safe is my money at the end of the day? So this interest expense is there to stay for now, and I don't think it's something that will wind out very, very soon, because the economy in itself has not healed yet. It still has a long way to go. We are still halfway there. So for it to heal, we can't just start dropping rates almost immediately. So yeah, we expect this interest rate environment to stay at this high level. We just all need to adjust to it. That's the honest truth.
You couldn't have said it better. We certainly all need to adjust. It's survival of the fittest, and very calculated risk as well.
Exactly. So the larger companies are able to back on the economies of scales because they are larger, they're able to,
they have the
averaging, they have the policy. But the smaller companies would suffer the most, but we expect that from time to time, CBN to bring out policies that will support the SMEs and the smaller ones that intend to die faster than the larger ones. But yeah, like I said, it's here to stay. Brace up, rearrange your books. Imagine that you're not going to be presenting very high margins this year and next year. So, but it is what it is. It is what it is.
In other words, be a realist about it.
Oh, very, very realistic in your financials.
Absolutely. Ajibola, I want to thank you so much for joining us on the Global Business Report. We'll see you again soon.